Right now, there is, well, one of the largest migrations of wealth in the world is happening quietly. It's moving out of Japan and into Europe.
Yeah, and the wild part is the country's central bank is practically powerless to stop it.
Exactly. Welcome to this deep dive, everyone. Today's mission is to give you an exclusive macro campaign briefing for Q2 2026.
Right, no jargon today. Just a clear look at this dynamic.
Yeah, we are focusing on the massive, almost gravitational flow of capital driving the euro to Japanese yen dynamic right now.
It's really one of those powerful forces in global finance.
It is. Now, since you follow the markets, you are likely already familiar with the basic concept of a carry trade.
Right, borrowing cheap to buy high yield.
Exactly. That is the fundamental engine here. It's the strategy of borrowing capital in a currency with rock-bottom interest rates, in this case, the Japanese yen, and then reinvesting it in a currency paying a much higher yield, like the euro, just to pocket the difference.
Yeah, it's textbook stuff.
But, I mean, what we are looking at today goes far beyond a simple speculative trade.
Oh, absolutely. What's fascinating here is that we are looking at a structural necessity. It's not just a trade anymore.
Right.
To truly understand global finance, and how massive institutional capital operates, you really have to understand this specific relationship.
Because it's not just day traders moving money around.
No, not at all. We're watching long-term foundational decisions play out in real time. It's driven by a persistent imbalance in the global economy that is just deeply embedded in the system.
And visualizing that structural imbalance is crucial for you as a listener. You already know capital flows to yield, right?
No, yes.
But to picture how inescapable this macro campaign is, I want you to imagine, imagine two massive water tanks, and they're connected by a giant wide pipe.
Okay, I like this visual.
Right. So one tank is completely full of water.
Yeah.
And in our scenario, that water represents yield or high interest rates.
The euro tank.
Exactly. The euro tank is full. The other tank, the Japan tank, is bone dry. Basic physics dictates that water will flow through that pipe from the full tank to the empty one until the levels balance out.
Just relentless gravity.
Exactly. Gravity. Right now, global capital is doing exactly that. It's flowing relentlessly from Japan, the empty tank, toward Europe, the full tank.
Yeah, and to understand the mechanics keeping that pipe open, I mean, we have to examine the drastically different environments of the European Central Bank and the Bank of Japan.
The two institutions basically controlling the water levels?
Right, exactly. And their current realities are wildly asymmetrical. Like, let's start with Europe.
Okay, lay it out.
The European Central Bank has successfully maneuvered its policy into, well, restrictive territory.
Meaning they're actively keeping interest rates high.
Yes, high enough to intentionally slow down demand and fight off sticky underlying inflation.
They've filled their tank.
They have. And despite the complexities of, managing multiple different national economies within the Eurozone, they actually have the flexibility to maintain those high yields.
Right. They can hold firm without triggering an immediate systemic crisis.
Exactly. But then you look at Japan.
Okay, let's unpack this. Because if you look at the other side of the pipe, the Bank of Japan is anchored near zero.
Yeah, they've been there for decades.
Decades. And yes, they've made a few incremental adjustments recently, tiny tweaks to their historically ultra-loose stance. But, I mean, if you are the Bank of Japan and you see mountains of domestic capital bleeding out of your country toward Europe, why don't you just rip the Band-Aid off?
Right, just raise rates.
Yeah. Why not just raise interest rates to normal levels and plug the leak?
Well, because doing that would trigger a catastrophic domestic chain reaction.
Really? Catastrophic?
Oh, absolutely.
Yeah.
Japan is carrying an astronomically high domestic debt burden. It's largely a result of decades of government spending.
Right. Trying to support an aging demographic and a stagnant economy.
Exactly. And on top of that sovereign debt, their entire financial system, from regional banks to massive corporate conglomerates, has grown thoroughly addicted to practically free money.
So the whole system is built on 0% interest.
Yes. So if the Bank of Japan suddenly spikes interest rates, the cost for the government to simply service its own debt skyrockets overnight.
Wow.
It would consume their national budget. And simultaneously, thousands of businesses that rely on 0% loans to survive would just fold.
Triggering mass layoffs.
Exactly. Immediate economic crisis.
So they are essentially trapped. They're trapped by their own debt structure.
That's the perfect word for it. Trapped.
Any attempt to fill their water tank and normalize rates has to be incredibly slow, right? Heavily telegraphed and severely limited in scope.
Yeah, otherwise they break your own economy.
Man. So that asymmetry basically defines the current macroeconomic regime.
It really does. Europe can hold rates high. Japan cannot raise them meaningfully.
And because the Bank of Japan is cornered, it cements that yield differential in place.
Yeah.
It creates a massive, unyielding incentive structure for any entity holding capital in Japan.
Which brings us to the actual players moving the market.
Right, because the gap in interest rates between Europe and Japan doesn't even need to be growing to drive this campaign, does it?
No, not at all. It just needs to stubbornly exist.
Just exist. And that sheer existence forces Japanese institutional investors to look abroad.
Yes. And we aren't talking about day traders here.
No, we are talking about the world's largest pension funds and massive insurance companies, the heavyweights.
Exactly. And if we connect this to the bigger picture, the demographics of Japan make this an absolute necessity.
Because of the aging population.
Right. Japan has a rapidly aging population, meaning their massive pension funds have millions of retirees relying on them for strict monthly payouts.
They need cash flow.
They desperately need it. To meet those massive liability obligations, these funds have strict long-term return requirements.
So if a pension fund manager keeps their capital sitting in Japanese government bonds yielding what, a fraction of a percent?
Yeah, barely anything.
The math simply does not work.
The fund will eventually fail.
Yeah.
They are structurally mandated to take their capital, convert it, and send it overseas in search of yield.
So it's not even a choice. It's like an inescapable ocean current.
That's a great way to put it.
Because when you look at currency markets, you see all these choppy surface waves, the daily volatility driven by geopolitical headlines or economic data releases.
The noise.
Right, the noise. But beneath those surface waves, there is a deep structural tide of institutional capital moving relentlessly toward the euro.
And the euro benefits directly as these Japanese funds diversify their global asset pools.
They are buying European bonds because they offer those stable, restrictive territory rates we talked about.
Yes. The outbound flows are moving mountains of capital because these institutions have absolutely no other choice. They are buying yield just to survive.
Wow.
And that consistent outbound flow provides a powerful, persistent tailwind for the euro against the yen.
Okay, so if you are an investor looking at your screen, understanding this current is one thing.
Right, the theory is easy.
Yeah, but figuring out how to actually execute a strategy around it is another. I mean, if we know this massive current of capital is flowing toward the euro, and we know the Bank of Japan can't stop it, how does a macro campaign execute on this without getting chopped up by daily volatility?
That is the execution challenge.
Because the actual strategy for this campaign involves building long exposure, positioning your portfolio to profit as the euro strengthens against the yen.
Right.
But you're supposed to do this precisely during periods when the yen is temporarily gaining strength.
Exactly. And execution requires intense patience and a really deep understanding of market mechanics.
So you don't just buy blindly?
No, the temptation with the structural narrative this clean is to buy the euro at any price. But macro discipline means you do not chase the trade at extremes.
You wait for a dip.
You wait for the market to give you a discount.
Here's where it gets really interesting. Because buying into a falling market feels incredibly counterintuitive.
It's terrifying for a lot of people.
Yeah. If I am watching my terminal and suddenly the Japanese yen spikes in value while the euro drops, my gut reaction is probably panic.
Sure.
Doesn't that sudden drop mean the thesis is broken? Why would anyone step in and buy the euro when the market is suddenly favoring the yen?
Well, you have to look at the mechanical reasons behind why the yen spikes during those moments.
Okay, what's the mechanic?
Almost always, those sudden pullbacks in the euro to yen exchange rate are driven by short-term global risk aversion.
Risk-off events.
Exactly.
Yeah.
When an unexpected geopolitical shock hits or a terrible economic data point drops, leveraged speculators panic.
And when they panic, they have to de-risk their portfolios.
Yes.
Right, it's a flight to safety. But wait, the yen isn't necessarily a safe economy, given everything we just discussed.
It's not about the economy being safe. It acts as a safe haven because it is the world's primary funding currency.
Oh, because of the cheap borrowing.
Exactly. Those speculators who borrowed cheap yen to buy high-yielding risky assets around the world suddenly need to unwind their trades.
They need to pay back the loan.
Right. To do that, they sell their risky assets, and they are forced to buy back the Japanese yen to repay their original cheap loans.
So it's a mechanical forced buy?
Yes.
Yeah.
That massive wave of forced buying creates a sharp mechanical spike in the yen's value.
Ah. So it is a temporary mechanical unwind.
That's all it is.
The surface waves are getting incredibly choppy due to a passing storm, but that deep ocean current of Japanese pension money hasn't changed its mandate.
Not one bit.
They still need yield.
Exactly. Those pullbacks are not signals that the global regime is altering. A sudden spike in the yen does not mean the Bank of Japan has miraculously solved its domestic debt crisis.
Right.
Nor does it mean the European Central Bank is suddenly slashing rates to zero. The fundamental imbalance our two water tanks remains entirely intact.
Therefore, these periods of yen strength are simply temporary opportunities.
Yeah, they are chances to align with the broader macro campaign at a heavily discounted price.
So discipline means scaling into the position over time.
Exactly. You use those brief moments of global panic to build your long exposure to the euro when it is, well, temporarily on sale.
That makes perfect sense. You rely on a clear understanding of the underlying drivers to keep you anchored when the surface gets turbulent.
Yeah, you have to trust the structure.
But, I mean, no macro campaign is invincible.
True.
To be truly well-informed, we need to stress test this thesis. We have to map out the specific macroeconomic shifts that could actually destroy the underlying machine.
Let's do it.
Looking back at our water tanks, one obvious threat comes from the European side. If the Eurozone economy hits a severe structural recession, the European Central Bank's mandate would force them to abandon their fight against inflation.
Right, they would have to aggressively slash interest rates to stimulate growth.
And if that happens, the euro loses its yield advantage.
The full tank drains out.
Yeah, the structural trade is dead.
A sudden, aggressive shift back toward monetary easing by the ECB absolutely invalidates the campaign.
The yield gap compresses from the top down.
Exactly. And conversely, we have to consider a threat from the bottom up.
From Japan.
Right. A meaningful, sustained tightening cycle by the Bank of Japan would also destroy the thesis.
If they actually manage to raise rates.
Yes. If Japan were to somehow engineer a massive wave of domestic productivity that allowed them to rapidly raise interest rates without imploding their debt structure.
Then the empty tank would start filling up on its own.
Exactly. The pressure differential would vanish, and the outbound flow of capital would halt.
Given the demographic realities and the debt burden we discussed, a miraculous Japanese economic renaissance seems highly improbable in the near term.
Highly improbable.
But it remains a structural risk. What about the institutions themselves, though? The pension funds and insurers are mandated to seek yield, but what if the Japanese government forcefully intervenes?
Oh, that's the third risk.
Because if the yen becomes so weak that it starts causing massive domestic inflation by making imported energy and food too expensive, couldn't the government legally mandate that those massive funds repatriate their capital back to Tokyo?
Yes. Forced structural repatriation is a very real tail risk.
Just to prop up the currency.
Exactly. If the Ministry of Finance were to enact legislation forcing domestic institutions to sell their foreign assets and bring that capital home, that deep ocean current would violently reverse direction.
The foundation of the campaign would crumble instantly as trillions of yen flow back into the country.
It would be a shockwave.
So we have ECB rate cuts, a BOJ hiking miracle, and forced capital repatriation. There has to be a broader global threat as well, right?
Well, yeah.
We talked about temporary risk-off panics where the yen strengthens briefly due to mechanical unwinding. What happens if that panic isn't temporary?
This raises an important question about differentiating between normal market volatility and a true systemic crisis.
Okay, lay that out for us.
A prolonged, systemic global meltdown. Imagine a multi-year depression or a cascading failure of the global banking system.
A real disaster scenario.
Right. That changes the psychology of the market entirely. In a true, sustained crisis, the sheer terror and the demand for liquidity elevates so high that the search for yield is completely abandoned.
Fear permanently overrides the desire for returns.
Exactly. In that environment, the rush into the yen as a funding currency haven would be overwhelming and sustained.
Drowning out the carry trade completely?
Yes, the carry trade wouldn't stand a chance.
It is the difference between a passing thunderstorm causing some aggressive waves and a Category 5 hurricane permanently altering the coastline.
That's exactly it.
So if you are reading the environment in real time, you have to recognize that a mixed environment one with normal intermittent economic scares and volatility does not break the trade.
No, carry remains the dominant force.
It only gets derailed by one of those acute, sustained macroeconomic shifts we just outlined.
The risk environment adds crucial nuance, and it demands that you are incredibly careful with your entry points. But unless one of those four specific conditions is met, the fundamental direction of the campaign remains intact.
So if we look at the landscape right now for Q2 2026, none of those doomsday conditions dominate the board.
Not currently, no.
The European Central Bank is holding firm to fight lingering inflation. The Bank of Japan remains thoroughly trapped by its sovereign debt.
Yeah.
The massive pension funds are still desperately seeking yield abroad just to stay solvent. And while the geopolitical landscape is always complex, we are not in a state of total systemic global meltdown.
Right. Weighing the inflexible central banks, the desperate institutional need for yield, and the remoteness of those immediate risk scenarios, the overarching bias of this campaign becomes incredibly clear.
What's the bias?
We are looking at a straightforward, persistent flow of capital in favor of the euro.
Meaning the trend stays.
Yes. Temporary price divergences, where the yen rallies for a few days or weeks, are simply a feature of the market's execution mechanics.
They do not contradict the overarching structural reality.
Exactly.
So what does this all mean? The biggest takeaway for you listening to this right now is a fundamental mindset shift regarding how you view market movements.
It's a huge shift for a lot of people.
In this specific macro environment, price is not leading. If you are just staring at a chart of the euro to yen exchange rate going up and down, trying to divine the future from the candlesticks, you are looking at the wrong indicator.
You're just looking at the noise.
Price is simply trailing behind the reality on the ground. It is following the path set by capital flows and central bank policy divergence.
The flow of the water through the pipe dictates the reality.
Right. The price chart is just trying to catch up to the volume.
And as long as the European Central Bank holds a meaningful yield advantage, and as long as the Bank of Japan remains constrained by its domestic debt trap, the carry-based tailwind for this dynamic will persist.
Because it's locked in.
It is an imbalance practically locked in place by the current macroeconomic architecture.
So as we synthesize this briefing into a probabilistic outlook for the coming quarter and beyond, the highest probability remains a continuation of the EUR-JPY campaign.
Without a doubt.
And the reason we can state that with such strong conviction is because the structural constraints holding it in place, specifically Japan's massive demographic cliff and their institutional return requirements, are forces that can only change at a glacial pace.
Yeah, these aren't quick fixes.
You do not unwind decades of zero interest rate addiction and demographic decline over a weekend.
No, it will take years, perhaps an entire decade, for Japan to restructure its economy to a point where they can meaningfully alter this dynamic without causing severe domestic pain.
So until that generational shift occurs, the highest probability is that the capital continues to flow exactly as it has been.
Right out the pipe.
This is why taking the time to understand a macro briefing like this is so incredibly valuable. By watching these massive, slow-moving levers of global liquidity, by understanding the constraints of central banks and the mandates of pension funds, you are looking at a hidden blueprint for how the world's money really moves.
You get to step back from the daily noise.
Exactly. You see the deep currents that actually shape the global economy, giving you a framework to filter out the panic of daily headlines.
Understanding the underlying structure allows you to recognize where the real power lies.
And keeps you from being shaken out of a sound strategy by short-term market turbulence.
Definitely.
Well, before we sign off, I want to leave you with a final provocative thought.
Well, let's hear it.
We've spent this deep dive exploring how the mechanics of this trade heavily benefit the euro and how Japanese institutional money is structurally forced to bleed out of the country in search of yield indefinitely. We know the pipe is open. We know the water is flowing out. But if that continues, if Japanese capital is continually shipped overseas to finance European growth year after year just to keep domestic pensions afloat, what happens to the domestic Japanese economy over the next decade?
That is the big question.
Think back to our 2 water tanks. We know exactly why the water is leaving the dry tank, but if the valve never shuts and the water never comes back, what eventually happens to the society built around the tank that's left completely bone dry?
It's a sobering thought.
Something to mull over. Until next time, thanks for taking the deep dive with us.